So the GST impact, what we have seen, the uptick in the growth of auto and some other consumer sectors. Uh, what market will watch out for is how this growth continues in 2026 in Jan, Feb, March quarter especially. So as far as first quarter of next calendar year is concerned, this will be the key thing to watch out for, that how this demand recovery sustains and picks up after that. So that will be the one.
Now let's talk about how are you positioned in your funds in terms of sectors. Any changes that you are looking at in 2026? Hello investors, welcome to Moneynomics by Axis Mutual Fund. I'm Shalini Gautam and I have with me our head of equity, Shresh Devalkar. As we step into 2026, let's take a step back, look how 2025 panned out for us. What are the key drivers for the markets in 2026? How are we positioned for 2026 and how should investors look at the year? So Shresh, let's begin. First, let's take a recap of how 2025 panned out for us. Various things happened. I think we have been through a lot. GST, tariffs. We saw a lot of FII outflows. Interest earnings have seen a change. So how do you see all of these panning out in 2025?
So 2025, we definitely saw these four key events which actually shaped the performance of Nifty and especially versus emerging market. So to begin with, as you highlighted, the tariff was the one. In case of tariff, generally what happened is India is expected to be taking a substantial market share in the supply chain. However, because of the tariff with US, that process might have got prolonged or delayed. That is one of the aspects of it. However, with lot of government support on policy, I'm sure we will be able to overcome that. The second event which happened was the GST rate cut, and that was really a big event in terms of its ability to boost consumption part of the economy. As per various estimates, it is around 1.5 lakh crore kind of stimulus. So that actually led to a rally in a section of market, especially auto and consumer discretionary. The third aspect was about the earning growth cut. So the earning cut cycle, which started somewhere in 2024, in our judgment, it might have got ended, or the pace of cut has now abated. So it has bottomed out. So from here, there is high chance that it moves up. So currently in this FY26, market is expecting somewhere around high single digit kind of growth. While on this base, the next year may be around mid-teen kind of growth. So the bottoming out of the earning cut cycle is definitely a good news which has happened in 2025. And lastly, when it comes to the FII flows, and that's where there is an angle of underperformance of India versus the global markets, especially the emerging market, that FIIs generally stayed away and invested mostly into AI beneficiaries across the world, which included obviously the Nasdaq of US. In Asia, we have seen in Taiwan, China, and other countries wherever they found bottom-up stories. So this actually led to the outperformance of those countries versus underperformance of our country as far as stock markets are concerned. And these are the four events, in my opinion, which actually shaped 2025.
Now let's talk about what do we see as the key drivers for 2026. So in your opinion, what key events and drivers could shape the market?
Events wise, let's go first by the fundamental part of it. So the GST impact, what we have seen, the uptick in the growth of auto and some other consumer sectors. What market will watch out for is how this growth continues in 2026 in Jan, Feb, March quarter especially. So as far as first quarter of next calendar year is concerned, this will be the key thing to watch out for, that how this demand recovery sustains and picks up after that. So that will be the one. Secondly, there are negotiations which are going on versus US and also with European FTA. So these two and the progress on it will be keenly watched out by the market. Obviously, as usual, the budget is the one which comes, which will be there in the first quarter. However, we always say that budget per se don't move things much, and as far as the government is concerned, they have taken multiple steps, even off budget as well. GST is the case in point.
Yes.
But I'm sure they will take some steps in the budget as well. That's why the budget will be definitely the key event.
Okay.
There would be state-specific elections, which are going to be probably in the second half of the calendar year. And again, in US as well, there will be certain developments on the election front. Even that part will also lead to how the trade negotiation happen worldwide and including India. So even the trade negotiations will be also guided by those events, the way it panned out in US. So these are the few things which will drive the performances of the global markets in 2026. Coming to India in particular, as I highlighted, already we have taken steps for boosting consumption part of the economy. Government is spending on the infrastructure. There is a capex which is already happening in power sector, data centers, as such, and some part of economy wherein we have observed that private sector capex is not broad-based. It is only in the specific areas. So that part is expected to continue as such. More important point which market will also watch out for is revival in the credit growth. There has been certain indications when we look at past 2-3 fortnightly data points. There is some uptick in the credit growth. So this revival in the credit growth, if it continues in the next year as well, that will be a welcome move. Already RBI has taken great steps when it comes to the rate cut as well as providing the liquidity support to the markets. And this will be very crucial when we are seeing currency depreciation. So if RBI continue to support in these tough times of currency depreciation as far as liquidity is concerned, and along with the lower interest rate, I think that will be the key for foundation for the credit growth uptick from here on, and that definitely market will watch out for. Both from RBI, SEBI, as well as government, there has been multiple regulatory changes and supports which they have come out with, like support to MSME because of, or the MSME which got hurt because of the tariff impact. There has been, as I highlighted, about the monetary policy as well. So and by government as well, there are multiple policy initiatives to support import substitution in India as well as exports out of India. So these all initiatives, I think, will lead to nominal GDP growth improving from here on, going forward.
Suresh, now let's move on to valuations. I think we are now more aligned to EM and global markets. Our valuations to them have compressed. Do you think they are, good compared to these developed markets as such? How do you read them?
So both developed as well as developing we can talk about. So when it comes to versus emerging market, our valuations at our peak went as high as almost 2 times standard deviation above the long-term averages. From there, it has corrected to 1 time standard deviation. And this correction is both because of underperformance of India and huge outperformance of emerging market. When you look at our valuation versus certain indices like Nasdaq, which is also a proxy to the AI story, way back in 2022, our valuation, the Nifty valuation, was closer to Nasdaq valuation. Today, we are around 24 times, while Nasdaq valuation is closer to 40 times. So there is again a huge valuation gap which has emerged. So this trade of AI, if it reverses for whatever reasons, already we must have heard about multiple data points around how huge capex is happening, and the recovery of this investment may be back-ended. So with this kind of realization, and more importantly with the valuation differential which has got created over last 2.5 years, both with developing market as well as with the Nasdaq or basically AI trade versus India. This valuation differential, there is a possibility that it may reverse in the coming years. For this, definitely the trigger has to be India's nominal GDP growth improving, and I think we already have the reasons to believe that it will improve from here on.
Now let's talk about how are you positioned in your funds in terms of sectors. Any changes that you are looking at in 2026?
Generally, just because the calendar year is changing, you don't end up changing something dramatically or
Absolutely.
drastically. Uh, However, we need to look at the way I highlighted that what has shaped up 2025 and what are going to be the prognosis for 2026. In that context, if we look at, my take would be, as always, which I always communicated, that the theme, the stories, the fast growth segment of Indian market have got re-rated substantially in last 5 to 6 years. While on the other hand, and the segments which are not growing so fast have not got re-rated substantially, and there the valuation is reasonable, one can say. Other parties, ROE of India Inc. is much better. That's where valuation has got elevated everywhere. But there are spaces where the themes are prevalent, and that in those pockets the valuations are too high. And that's where in this calendar year, the way we also highlighted in 2025 last year, that market is going to focus on both valuation as well as growth. So it will not just chase growth, and that's where investing in growth at reasonable price would be the key, which will continue in next year as well. In this context, we have increased over last 6-7 months exposure to financial services with various steps taken by RBI and reasonable valuations. What we have seen in this segment, we continue to remain underweight on the export-oriented sectors. Though in some pockets valuations are good, but still we continue to remain underweight on the export-oriented sector. We are overweight on consumption part of economy and select investment part of economy, the likes of defense, etc., and power sector capex on the investment part of the economy, and on the consumption part of economy there are multiple plays. So these are the two segments which we are where we are overweight on, and in that particular, as I highlighted, the financial services exposure was increased over the last 6-7 months.
So now 2025 is going to be the 10th consecutive year of positive returns. How should investors look at investing in 2026?
Again, as far as investment is concerned, again, this calendar year doesn't change so much, but broadly the suggestion always has been that be diversified across asset classes, whether it is Indian equity, it's gold, it's foreign equity. Definitely Indian equity has to be the largest chunk of it because of the we being a fastest growing economy, but also having exposure to other asset class is important from the investor's point of view. As far as from the Indian equities, if you want to choose, then be with diversified funds. So it can be flexi cap, or it can be large and mid cap, or multi cap, because in my opinion there is no point in choosing large versus mid versus small. Bulk of large cap is slow growing, and that's where reasonably priced. Part of mid cap and small cap is fast growing, and because of it is very highly priced, and that's where there is no point in taking one risk over other. It's better to mix, and it's better to choose among all.
Thank you, Shreyash, for your detailed insights, and a big thank you to all our investors for joining in today. Happy investing in 2026.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.